Welcome, and thank you for joining an exciting panel today, Data, Innovation, and Consumer Lending. We've got three fantastic panelists, and we're just going to dive right in. I wanted to kick things off with a discussion about, unsurprisingly, data. You guys position yourselves, Trust Science, as a credit bureau 2.0. What is so special or better or different about what you're doing compared to the credit bureau 1.0? And as a follow-up, why don't credit bureau 1.0s follow suit?
Thanks, Miles. Good opening question. Thank you very much for having me, first of all. Congratulations to my man over here to the right, because they raised $50 million yesterday, and their results have been absolutely phenomenal. Unannounced, I think you're going to be retiring soon with all the appreciation in your stock price.
That's right.
Yeah. So let me start with this, just maybe a brief question. Anybody who's a lender out there who's using FICO, Beacon, and Equifax risk score exclusively to do your scoring and your underwriting, please put up your hand. And don't be shy. There's nothing wrong with it. 1, 2, 3. Very few. Those who are lenders and actually augment it with additional data, phenomenal. So thanks for the introduction. I'm the head of financial services over at Trust Science. We are not just a credit bureau. We do have the branding Credit Bureau 2.0 or Credit Bureau Plus. And the idea there is that we're augmenting with additional data, some traditional bureau data. The reason I opened up with a question about FICO and Equifax risk score, or Beacon for that matter, is because it's very limited. They're limited in really three respects. One, those models were built roughly 6 years ago. So they're antiquated. They're rear view mirrored. They're based on trade lines that happened 6 years ago. By the time they get developed, by the time they get through QA, by the time you assume it and ingest it into your system, get comfortable because you don't want to be the guinea pig, it's 6 years old. Number two, it's single poled. It's only their data that you're relying on. You want multiple data sources of data. And probably most importantly is that it's not one size fits all. So their scores are used for mortgages, they're used for installment loans, they're used for auto, small dollar payday loans, lines of credit, Ours, to differentiate, is product specific. So we have models that are built off machine learning for purposes of each specific product. We are data agnostic, but data hungry, meaning we'll get data from every possible source we can, whether it's consensually through our customer base, through business partnerships that we've established, including TU and Equifax. So we can use your credentials, or in the United States, we resell those data sources as well, that ultimately culminate into a robust score using machine learning that's continuously refreshed. And with that, recommend loan amounts, risk-based pricing, and the advice with regards to how to structure your particular deals and the like. So that's kind of Trust Science. It's an automated SaaS platform, not just a credit bureau.
Got it. Okay, that's really interesting. I know, Asaf, you guys at Fionic, you have your own unique approach to both underwriting and lending. What's so special about it, and how do you guys use data to give you an edge?
Yeah, thank you. So I think all panelists here, we agree that the traditional FICO scores and the one score fits all is really outdated for many years. And I think we also represent three different approaches to how to utilize new system of assessing the risk. So as Chris mentioned, they provided the new scoring, specific scoring, etc. GoEasy is more direct to consumer. And we also working with businesses, but we are also taking into our account the funding solution that comes with the actual risk assessment. And by that way, so we also, of course, use multiple data sources and utilize like the latest technology and machine learning algorithms. And we have also our specific mathematical modeling of the problem, but we utilize that together with our capital provisioning to create a more robust solution for the portfolio risk management and not the single scoring solution, which is also like has a lot of deficiencies, but we look on the grand picture of the risk assessment from the capital provider endpoint, and thus we provide that capital with our solution.
Got it. Okay, got it. Jason, like Chris mentioned, congrats on the bought deal. It sounds like you guys are well positioned for some of the opportunities that you're seeing in the market. I saw in your IR deck, your most recent one, that you guys, I think this quarter, are releasing your next generation of credit models. What does next generation in this context mean, and how does alternative data play a role in that?
Yeah, great question. I would say, we call it next gen, so let's just call that what it is. That's our internal label. So it could meet different definitions, but I'd say there were 2 or 3 things about these next generation, I've now used the term, of models that we've come up with. One is they're based on larger and larger data sets. And anyone, certainly my colleagues on the panel and others in the room will tell you that the more data you can put into your models, the more robust they're going to be. And like any growing lender, we were once a smaller lender, so when we started building our first generation of proprietary and custom scorecards, they were really built on small populations. And they had a pretty decent amount of variability in them. But as we've experienced growth and ingested a lot more both goods and bads, our ability to be that much more predictive has really accelerated almost exponentially. So first and foremost, they're based on more outcomes. Secondly, as both of my colleagues have said, they're based on more data. So we consume, obviously, credit bureau data, the raw data, not the scores, because we build our own. We ingest and supplement that with alternative data sources, a good example being banking data. Some of our credit models are either what we call hybrid models that consume both banking attributes and traditional credit attributes as well as application data, and others are banking only that we typically try and use to attract those customers who, quite frankly, don't have a credit bureau, and they're either invisible or not able to qualify because their trades are so thin or their credit bureaus are so thin. So more data, more diverse data sources, and then, and I think a lot of groups have done this, more exotic forms of statistical modeling to build the models. So gone or long gone, depending on who you work for, are the days of straight old linear regression models to build your credit scores. Gone are the days of just relying on logarithmic credit scores to just build your models and your scores. Now there are far more interesting tools and methodologies. I can put out some fancy schmancy words, but I won't try to describe them, that are further advancements on the power of how those models can predict. But one of the things you have to be wary of is some of these more exotic flavors of modeling are a little bit harder to be transparent in understanding why the models behave the way they do. They may be really good at predicting an outcome, but you'll have a hell of a time with some of these model types to understand why that outcome is so. And if you're a modeler or belong to a lender, especially a lender that's a regulated lender, and you need to explain those modeling attributes to your customer when you either approve them for a loan or don't approve them for a loan, now you're in a tough situation. So you still might have the world's greatest and most sophisticated modeling tool to predict risk, but you can't tell a customer why they can't qualify for a credit card or an installment loan or a mortgage. At least with the models that we've built, we try to do a little bit of art and science, a combination of using these latest tools, but not building models that are, quite frankly, unexplainable. Because as an organization with 400 points of distribution, we owe it to our customers to tell them why, if we can approve them, why we did, and more importantly, if we can't approve them, what kind of behaviors they can adopt and do in order to get approved at some point in the future. So those would be 3 examples of things that we think make these next generation of models that much better.
Okay, so I think this is the answer to that question is going to become important here. When we think about data, we're usually talking about something in the past. In the last 12 months, the lending backdrop has changed quite dramatically. How do you guys, and Asaf, we'll start with you, how do you guys make sure that the models that you've used historical data as for prediction are still robust in today's lending environment?
Yes, that's a very good question, and I think like one of the most common questions for the last decade, like when you use AI models, everyone asks you like, how would it have performed in 2008? How would it have performed in 2000? So I think, interestingly, the next year they're going to ask about is how it is performed in 2023. So we are very excited about being tested in the environment with the right toolkit to support our decisioning. And the way we approach it is basically starting by the fact that the changing in macro environment is a problem both for the manual underwriter and the automated, sophisticated underwriter. So if you take the practices and the know-hows from the lending industry from the last 40 years about how to evolve into a downturn and how to adapt your models to that, you can build that same process around database models, which are better in the underlying risk assessment, and then you can make sure you use them properly also in a downturn. So that would be the first part of my answer. And the second part is that the way we think about it is it's not like anything in the risk ladder is going to inverse. Like you have the best performers and you have the worst performers, and they're probably all about to move inch to the left. And then potentially, if we will be able to track these movements of borrowers, for example, from prime to non-prime, from non-prime to subprime, etc., so we can understand better how those borrowers are going to react to the downturn and actually serve them in a more similar way to how we would serve the borrowers before them in that same position. So in that sense, you can stay in a, you would have to have higher APRs, but relatively lower than base rate and potential higher defaults because you have a better population coming towards you in some segments of the market.
Okay, and Chris, is that consistent with how you guys view it as well?
It is. I would augment it a little bit. I think it's a good approach and a good summary as well. We continuously refresh our models on a regular basis. Our models are fed by a give-to-get model with our lenders. And so much like a traditional bureau, we're getting performance back, depending on the product, at least on a monthly basis from our lenders. And so that continuously allows the machine to learn. The machine has been trained, it's supervised, because all models require adult supervision. We actually independently audit it as well with, to make sure it's explainable, to Jason's earlier on point, because it's critical, particularly because we're operating both north and south of the border. So that continual refreshing is important because you're continuing to feed it. And then on a very regular basis, which is usually monthly, if not quarterly, we're actually doing stability reviews. And those stability reviews are essentially ensuring that the models are performing in production in a manner consistent with the way that they were built, intended, and trained. And that is imperative, because if we ever deviate from that, our lenders would not be very happy, needless to say. And then finally, we're talking about macroeconomics. I mean, we've been around for 10 years, but in production for 5. We've invested over $20 million in our decision engine and data aggregation and analysis, and we've gone full gamut from completely unstructured data to otherwise. But with that, we basically are looking at a macroeconomic view that has changed with COVID, with Putin, with this hyperinflation. And so, what used to apply before in FICO and Beacon working or not working, as the case may be, is just that much more ineffective. And so we've looked at that through a completely different lens. And we have built our models using targets. For those of you who are familiar with the concept, or you're basically training your models to perform in a particular way. Most customers are looking at a lifetime value of their customer because they're here for longer. They're not one and dones. If you're looking at auto, it might be a one and done. So you might be looking at your profitability after an 18-month period. Generally, those who are operating in the auto lending world, after 18 months, you generally know whether this is going to be a good or bad loan. On the shorter term nature, you can look out 90 days, et cetera. Even the payday loan, small dollar loan guys, they'll know in a month, right? So typically, our models we built off of a lifetime value. In the event that there is a change in the macroeconomic environment, we respond in 2 different ways. We can change the targets to a more short-term or mid-term. We can go from a lifetime value to 180 days, or to a 90-day DPD, or to a first payment default target. And then with that, now your scores get reset. Alternatively, you can just adjust your scores. And so in that fashion, that's the way we manage and provide solutions to our lenders, and that's why they're happy.
Okay, so Jason, I want to change the question just a little bit for you since you guys have been around for so long and seen a number of cycles. Oftentimes, when we see market shifts like this, companies put on hold innovation and they sort of buckle down on the core business. How do you guys make sure, or do you, that you're continuing with innovation and pushing on some of the opportunities that you're seeing in the market?
Yeah, great question. It's funny, you state it purposefully as an or I think that's an and question. Because I think the benefit that some lenders who have scale can afford to do is you can still afford to tighten up in your core business if you believe that business is at risk. But what recessions or even economic uncertainty give you the opportunity to do is test around the edges to see, amongst other things, how robust your models are and, quite frankly, how much more incremental risk you're prepared to take. So one of the things that members of our group, some of whom are in the audience, can certainly appreciate is I'm very much pushing even more testing during the current environment, recognizing that we've been making proactive credit adjustments dating back to Q4 of 2021 when we started to see the market coming out of COVID and normalizing with respect to payment behavior. And we started to see the first signs, if you will, of an uptick in inflation and some weakenings in the real estate market around Q1, Q2 of this year. But that hasn't stopped us from trying to figure out ways of operating in the margins. The difference is we're not putting gazillions of dollars at risk in the process of understanding and learning from those experiences. We're putting a smaller amount of dollars at risk in the process. And the more tests you have running, provided those tests are significant enough that they can give you a decent read, think about how much more powerful your learning is going to be coming out of an economic cycle as the one we're in, where you have some of those learnings, which if they survived and worked well in an uncertain time, can you just imagine how good they're going to perform when times are better? At a time when perhaps some of your competitors are asleep or perhaps not able to be as aggressive in the market because maybe they didn't proactively adjust or maybe they didn't have the same degrees of freedom because of capital or other factors that they couldn't make those adjustments. So I would say, generally speaking, in answer to your question, Miles, is the thing I would encourage lenders to do of all sizes is you should test regardless of the economic circumstances. You just have to be mindful of how big you want those tests to be. And that, quite frankly, is mostly a function of what risk you're prepared to take. But if you make a lot of small bets, as opposed to a couple of big bets, you'll have far more flexibility when it comes to picking the ones that will ride you home when things start to improve.
That's interesting. I want to switch gears just for a second here. We're talking about, obviously, data, which becomes an input for some type of decision to be made. In this case, lending to consumers. We've heard for decades, or it feels like decades, about automation and how that's going to change the way that we lend to consumers. I want to get your guys' take on how much are we seeing automation in this space and how much value is it actually creating? Because we've sort of been promised or told about these benefits for a long time. How real is that? And at what parts of that decision-making process are we seeing automation? And maybe, Asaf, do you want to start, and then we'll just work our way this way?
Sure, my pleasure. So actually, as a B2B player in the market, working with originators, our side is always 100% automated. And then, of course, we acknowledge the importance of some manual processes to reduce risk, whether it's specific proof of income or fraud verification. So we see a variety of levels of automation, and also in my previous lives, I've worked in the US market, and also like you have peer-to-peer marketplaces, you have direct-to-consumer originators, and you have in-person stores. So I think in the last 5 years, I guess, you see a rapid adoption of more and more automation. There is, because of the size of the industry and the importance of not being reckless about adoption of innovation, then it takes more time, specifically on the consumer-facing side, to do that. But in the back end, in the processing of the applications and the decision making, I think it's close to 100%.
We're 100% automated and digitized. Whether we're supporting lenders who have a storefront or those that have both an online presence, fulfillment or otherwise. So, and we use endpoint APIs to basically communicate information back and forth with our lenders, as well as our business partners who are providing additional data sources. In the case of consensual data, such as telco, utilities, banking, and so on, we have something called smart consent, which is protected by IP. We have 45 patents protected, 45 IPs protected by patent globally, I'll get that right, in about 14 countries, including China, which is amazing that we got that. And so with that smart consent, we're able to communicate with the consumer directly, and using iframes, we're able to embed ourselves, in the case of online lenders, right into their loan application process, so the consumer experience is seamless. They never leave their website. They're just basically providing a permission there. Full disclosure, so we're always compliant, both legally as well as from a regulatory perspective. So between iframes and APIs, and of course our decisioning is, it's cloud-based. So we're SaaS, we sit on AWS, and because we're fully digitized, obviously the security protocols that we have are very severe and tight. We service Sched 1 banks here in Canada. There's a couple of charters that we're working with currently, who are nameless, as well as some state and federal banks stateside. And so their vendor procurement program is obviously extensive. We've gone through those time and time again and passed with eyebrows being raised saying, well, it's pretty cool. And our SOC 2 phase 1 has just been completed, and so we got thumbs up on that as well. So it's really, it's a composition of making sure you're integrated from a technology perspective internally, where your own machines are going guppity-guppity-gup, making sure that you're integrated with your business partners, the lenders, your business partners, the lenders, as well as the consumers, and then making sure that you carve out an appropriate box around that to protect what you've built.
Got it. And Jason?
Oh, I'd say we're mostly automated, certainly on the decisioning end for sure. But because we focus on the non-prime consumer, I would make a very strong argument to say is we prefer to walk them through the transaction. Now, we've digitized that transaction, but what we'll tell you is where we're able to originate, close, and service one of our customers in a branch, we'll get 2 times the lifetime value as if we gave that customer the opportunity to close that loan digitally online. And that's for a number of reasons. Probably the most important one, at least for this particular customer segment, these customers value the additional added relationship and advice you can give them on how to manage credit. Perhaps for the prime consumer, where you've got stability of income, let's say reasonably modest debt-to-income ratios, depending on what segment you're in, but reasonably modest debt-to-income ratios, maybe you don't need that because these consumers are self-sufficient. But for the 1/4 of Canadians who are non-prime, whose scores fall below a reasonable threshold, I would submit you want to be very careful on how much of that transaction you choose to automate. By all means, take the friction out of the experience, but don't take the person out of the experience, because these individuals are not prime consumers for a reason. They struggle with debt. They can't always manage their payments on time. They sometimes don't know the difference between too little debt and too much debt. So some of that responsibility, at least as we look at it as a lender, falls to us, especially because we believe in it and because it's the right thing to do for the customer. So I would say we are mostly automated, but we have a very strong bias toward keeping the customer front and center in that transaction and not removing all of the friction, because some of that friction is actually there for the customer's best interest.
Okay, so that's interesting, and sort of is a nice segue into the next question, which is one drawback of automation, or one of the challenges with it, is the susceptibility for more fraud, or the potential for more fraud. What are you guys doing in your businesses to remove the potential for fraud, particularly as the lenders, and then also for your clients? Maybe Jason, we'll start with you this time.
Yeah, we're pretty fortunate. Again, we are a installment loan lender, so I typically, if I were a card-only lender, I might have a different set of answers. For us, fraud is not a terribly large concern for a couple of reasons. We've designed our automation on the web, which is where we source about roughly half of all our loan applications, to be pretty robust. And what I mean by that is it's not so generic that you can let anybody with a pulse in the door. If you're going to do that, you might get lots of people knocking on your door, but half of them you can't open the doorknob anyway because you're not going to want to fund them. So we try and find that appropriate mix that says, are you good enough for us to take a second look at automatically, yes or no? And if not, try somewhere else because we don't want to talk to you. And as a result of that, and the fact that not all of our processes are fully automated, a lot of our loans still get a, let's call it an unofficial second look, either in the branch or through our central loan approval office. We catch an absolute majority of the fraud to the point where it's single-digit basis points when it comes to impacting our business. So I think a lot of it has to do with the kind of product you offer, the customer segment you're targeting. There aren't a ton of non-prime consumers out there committing mass fraud with crappy credit bureaus. The far more likely perpetrator of fraud are, I got a clean bureau because you can give me 25 or 30 or 40 grand of unsecured money so that I can walk away and not pay you out for it. For us, that typically doesn't attract the right kind of customer. But again, if I were a card issuer, prime only, I would have a different set of answers because at that point, unless I've got some really strong controls, automatically or even manually built in, it's very easy for a customer to come in, whether it's through synthetic identity or true identity, to come in and deceive you, or mostly deceive you, to the point where you're willing to give them money. Even if that money is a smaller dollar limit, you're already letting that money go out the door. But in our particular case, we've got some pretty robust controls, but we're not over the top on fraud because we've not fully automated the process. And while that may have, as I said before, given us some friction in the process, it comes with the benefit of not having to charge off lots of amounts due to fraud. It might be different for other lenders, but that's been our experience.
So looking at it through two lenses, perhaps one as a corporation that is vulnerable to attacks for our PII as well as our engines. We need to make sure that we have run vulnerability testing on an annual basis. And so we have third parties that come in and try to poke and prod and penetrate our systems to find out where the weaknesses are. And we've come up with grade A's. So we've been good, and knock on plastic, that will remain the case. But nobody's iron proof. And so we continue to seek better ways. From the lens of a lender and our customers, we're always looking at it through providing additional services. So, and those services include KYC and fraud services, which are multiple. And those are, rather than recreating the wheel, we have chosen to gone through with wholesale rates and purchase these, and then package it up with our services to render it back to our lenders, so that as a lender, rather than, it simplifies your vendor procurement program. So instead of having to deal with 5 guys, you're dealing with us. Instead of paying 5-time multiple, you're paying us once. The contracts are easier to deal with. You've got one person to deal with if you ever have an issue. The relationship management's easier, and the service is quite frankly better because they know we've done the due diligence in going out there and choosing the best providers in those regards. There are a couple of really cool ones out there that have come out as of fairly recently too, that help not just deal with fraud, but automation with regards to the use of phone and the data that resides on the phone, and the ability to authenticate people using the data on the phone for purposes of KYC and fraud prevention, but also to auto-populate your loan applications. And it improves the customer experience, reduces cycle time, drop-off time, where people get frustrated because they can't get their postal code in there or their email address and the like. So so it's multifaceted, and it's pretty cool stuff.
Cool. And Asaf?
Yeah, so our approach is that we are mainly focused on the stuff we feel we have like a really competitive advantage, which is the decisioning and underwriting. And actually, because we see through the data and the technological advancement that every aspect of the chain of lending can be significantly improved throughout data models and technologies. So we focus on our offering of the underwriting and risk assessment, and then for the other stuff like fraud and KYC and also originating and servicing, we see that as stuff that we leave to our partners or outsource vendors, and then eventually, if like our view of the future is that you will have strong players being fully dedicated in the data and technology side, specifically for their aspects.
Right. Okay. Well, I want to first thank the three of you for coming up here. It's been a fascinating discussion, and thank you everybody for joining. We'll give you a minute and 13 seconds back. Thanks.
Thank you.
Thank you.